I want to share a very simple strategy that consists of only 2 indicators, and it is well suited for beginner traders. And this, unlike other strategies for beginners, this is a new strategy that trades in just 1 minute. That is, the trades will appear very often, and this will allow you to increase the number of trades and potentially increase your profits. Right away, I want to stipulate that the scalpel of the new strategy is not suitable for everyone. First of all, they are best suited for people who can spend a lot of time trading and follow charts a lot. Can you set aside a few hours of trading time a day for yourself, during which you can explore opportunities in the market and make trades? For scalpel, the strategy is not appropriate. Pending orders. You need to specifically watch the chart and manage each trade individually. But if you are the kind of person who can devote a few hours a day to trading and who can carefully and, most importantly, patiently make trades on strategies, this strategy may work well for you. So, let's move on to our indicators. The first indicator we put on the chart is an indicator. This is classic theater that shows at the level of overbidding and overselling on the chart. For him, I recommend you change the parameters. Set one parameter to 15. Set the other two at level 4. So, we've set up our TEC, and let me briefly explain how it works. A strategy for beginners. Many may not have encountered this indicator before. We have a theater that shows overbuy and oversell levels on the chart when both lines go beyond the lower boundary of the cost. This indicates an oversold level and suggests that the asset is now cheaper in the market than it was on average before for the 15 candle period in question, which means it is more likely to trend towards the average and bounce upwards. And vice versa. When we have both lines entered the zone, it means that our chart has been growing for a long time and has already reached the point at which it will be profitable for us to buy, which means it trades on average more expensive than it did over the previous 15 candles. And as I said, the charts often tend toward their mean, and they often bounce down from oversold levels. And as you can see, the stats we have fluctuate between bought and oversold zones, and often go beyond those levels, and often bounce off of them. As you can see, it largely duplicates the overall movement of the chart. So the second indicator for the strategy we have will filter out the signals we need. That would be exponentially moving, averages, we need and search to punch in and select. You can go to the settings of this indicator. Application must be by closure. We need, and it is the period that we set, 200, put it on the chart. 200 moving averages show us the general direction of the trend. And it means that with any strategy we should make, try to make trades in the direction of the general trend, which means when we have a chart and candles higher than 200 moving averages, we only trade up and ignore down signals. And vice versa, when we have a chart under the moving average. Now we're going to find a period where we have a chart under the moving average. So our overall trend is down, a falling bearish trend, which means we should only consider down trades and ignore up trades. As I said before, the stats show levels bought oversold, but unlike classic indicators like we have 2 lines here, we have a moving average crossover system built in here, which means the main signal is when it's fast, moving average. In our case, the blue crosses the orange, either from top to bottom or from bottom to top, when the fast slider crosses the slow slider from top to bottom. It is a signal to trade down when a fast moving average crosses a slow one from bottom to top. This is a signal for an upward trade. That's it. So we consider the signals in that order. First, we look at where the graph is. If our chart is under 200 moving average, we open trades only down. If the chart is under 200 moving average, we open trades only up. And then we look for specific entry points, like let's open a chart for a random point in the past. Just a little more spin. Let's take just a random period to do a little effects strategy. So let's start with this period. So we now have the chart, cross the 200 moving average is above it, which means that we will only consider upward signals on statistics. We are looking at the indicators and waiting for it to enter the oversold zone. Here we have a graph. We are now waiting for our moving average to cross. So here's the blue moving average crossing the orange moving average from bottom to top. This is a signal for an upward trade. The chart is still at the 200 moving average. So at this point, we're taking an up trade because that's the strategy. We have fast, very accurate transactions. We open a trade for 3-4 minutes for 3-4 candles. And here we already fixed the profit. Let's see what signals we have next. So here we have the chart cross the 200 moving C. It is now at the bottom of the 200. Now we're only looking at downside trades. As you can see, there were no such deals here. Here we have a trade down, but at this moment the chart crossed 200 upwards again, and therefore we also missed such a signal. We're looking for a more precise trend. As you can see, this mechanism of mutual filtering of signals helps us avoid new markets, avoid moments when we don't have a clear trend, and avoid inaccurate trades. So let's keep looking for good entry points. As you can see, the situation here is the same. We have a chart under the 200 moving average. We are getting a signal to trade up. We skip such a signal because our chart is 200 sliding. And as you can see, this whole section, we just skipped over, not making any deals here because they wouldn't have been accurate. And now we have found a new trend, a new long-term move above the chart. And now we're looking for zones. When we get a definitive signal. Here we have a chart in an oversold zone. Again, the blue moving line crosses the orange moving line from bottom to top. That gives us an upward signal. Here we open a trade for 4 minutes. And here we are already locking in a profit at the high. And again, we made a profit. As you can see, even though the strategy is built on a 1-minute chart and trades are made quite often, we actually miss quite a few trades and only enter very precise ones. And that's the main principle, that we should ignore bad trades and only enter the market on trades that we are very confident in. It's a very simple strategy. I also advise you to combine it together with your partners. For example, specifically at this point, we had, you see, there was a bullish engulfment. We have a green candle bigger than the last red candle. This is further confirmation that we have a good signal for an up trade. And through such additional signals, you can still strengthen your trades and be confident in the ones you enter. A very big, very important point about the new strategies. Be patient. Don't get into borderline trades. Don't get into trades that are just on the borderline 200 slip. Maybe go in, maybe don't. We only enter exact signals. Only signals in which all our conditions match perfectly. Trust me, on a 1-minute reception, candles appear every minute, which means you will have quite a few signals. And there is no point in following signals that are some borderline and can lead us to losses. Remember that patience and clear strategy research are the 2 main rules for making profits in the market. Be sure to try this strategy and record the results. It may be more profitable for you than your strategy. It will become one of your main strategies in the future that makes you profitable.